Hello, my dear CMA Inter students. Welcome to our YouTube channel. Today we are going to discuss AS11, that is effect of changes in foreign exchange rate. This AS comes into picture because of the foreign transaction. Whenever we enter into a foreign transaction, how that foreign transaction will be recorded in our books of accounts, that we are going to discuss in AS11. This AS11 we divide into three parts. Number one, foreign currency transaction. Number two, foreign operation. Number three, forward contract. Right. So whenever we enter into a foreign currency transaction, right, so that foreign currency transaction, how will you record in our financial statement, right? So first of all, we need to understand what do you mean by reporting currency and foreign currency, right? So reporting currency means a currency in which the financial statement are prepared, right? For example, in India, we prepare our financial statement in what's by using what? In rupees. So this is our reporting currency. Whereas in US, they prepare their financial statement using what, sir? Dollar. So dollar is a reporting currency for them, right? So what is reporting currency? A currency in which the financial statements are prepared. Then what is foreign currency, sir? Currency other than reporting currency we call as a foreign currency. Like for us, rupees is a reporting currency, so dollar will become foreign currency for us, right? Okay, then first we have to discuss number one, what is foreign currency transaction, because I told you this AS11 we have to divide into three parts. Number one, foreign currency transaction, right? Then forward contract and foreign operations. So first we'll discuss what do you mean by foreign currency transaction. Foreign currency transaction means a transaction which are denominated or which require settlement in foreign currency, right? For example, when we export goods in US, we require money in what, sir? We receive money in dollar, right? Yes or no? So that transaction become which transactions are foreign currency transaction, right? So foreign currency transaction is a transaction which denominated in or require settlement in foreign currency, right? For example, buy and sale of goods or borrow or lend fund, when the amount payable or receivable which is denominated in the foreign currency. Are you getting my point, right? Okay. Now, whenever there is a foreign currency transaction, we have to record the foreign currency transaction in our books of account, right? So, how to record the foreign currency transaction in the books of accounts, right? First thing, there are three stages, okay? How many stages are there? Three stages. Number one, initial recognition, then subsequent recognition. In subsequent, we have to write in the balance sheet date and settlement date, right? So three things you have to remember whenever we record the foreign currency transaction, right? Okay, so first one, initial recognition. The foreign currency transaction should be recorded on initial recognition by using which rates are spot rate. So what is spot rate? Spot rate means a rate of a date on which transactions are entered. Like today, if we enter the transaction today, what is the rate? That rate we call as a spot rate. So initially we should record the transaction at a spot rate. Okay, sir. Then each balance sheet date we have to subsequently remeasure it, right? So what they say, first we have to identify whether the foreign currency transaction resulted into creation of monetary or non-monetary item, right? Because when you enter into foreign currency transaction, so that foreign currency transaction we have to check whether that resulted into creation of any monetary or non-monetary item, right? So I'll tell you what is monetary, what is non-monetary, don't worry. Okay, so once you identify whether the foreign currency transaction resulted into monetary or non-monetary, if it is a monetary item, then it should be recorded at a closing rate. On the balance sheet date, you have to record at a closing rate. Which item? Monetary item. So non-monetary item, generally non-monetary item we record at a historical rate. So generally we do not make any changes in the non-monetary item. Is that clear? Yes or no? Right? Then you may ask me, Sir, what do you mean by monetary item? What do you mean by non-monetary item? So monetary items are the money held or the item of assets and liability. Monetary item can be the item of assets or liability to be received or paid in fixed or determinable amount of money. That means monetary item means those item of asset or liability which are receivable or payable, which is fixed or determinable amount of money. For example, my dear student, cash. In our balance sheet, just visualize the balance sheet format. In the balance sheet asset, we have the cash. So cash is a monetary or non-monetary, sir? Monetary, because it is a fixed. Sir, in the balance sheet, there is a receivable. So receivable means what? Debtors. We know how much money we need to receive from our debtors. So it's a fixed, right? Same thing, payable. Creditors is there in our balance sheet. It's a liability. We know how much we need to pay him, right? Which is again what, sir? Fixed, right, my dear student? So monetary items are those items of asset or liability to be received or paid in fixed or determinable amount. Is that clear? Yes or no? So balance sheet other than monetary item which is not fixed, we call that as a non-monetary item. For example, PPE, machinery, right? Then investment, then inventory. They all are the non-monetary item, right? So non-monetary item are assets and liability other than what, sir? Monetary item. Okay, for example, fixed asset, advances for purchase of, goods, fixed asset, inventories, investment in equity shares, right, my dear student? So these are the non-monetary items. Okay, so whenever initially you recognize the foreign currency transaction, you should not think anything, right? Whether it is a monetary or non-monetary doesn't matter. Initially, you should record the foreign currency transaction at a spot rate. Then subsequent recognition on the balance sheet date, you have to identify whether the foreign currency transaction resulted into creation of monetary or non-monetary item. If it resulted into creation of monetary item, then you have to record at a closing rate. If it is a non-monetary item, you have to ignore that generally. Is that clear? Because non-monetary item we record at a date of purchase. What is the rate of a date of purchase? That date rate we take. That's why generally we won't subsequently measure the non-monetary item. Okay, sir. Then reporting on the settlement. On the settlement date, again, settlement means what, sir? When we are liable to pay or we are going to receive the money, right? So my dear student, always remember, whenever there is a difference from initial recognition till the balance sheet, the difference we have to transfer to P&L account, and same again from balance sheet date to settlement date. If there is any difference, it has to be transferred to again profit and loss account, right? Is that clear? So that is what I have given here. So any exchange difference arising should be transferred to statement of profit and loss account, right, my dear student? Yes. Okay, so one example is there. We'll do this example. So what happens, sir? Goods purchased on 1/1/2024. How much, sir? 15,000 US dollar. How much is $1 is equal to 75 rupees? Yes. So when we purchase, what will be the journal entry, my dear student? Entry will be purchase account debit, right? So entry will be purchase account debit towards our creditors account, right? Purchase account debit to creditors account. How much will be the amount, sir? Initial recognition at a spot rate. What's the spot rate? 75. So 15,000 into 75. So 15,000 into 75. This is called initial recognition at a spot rate of a date on which transactions are entered. This is which dates are 1/1/2024. After that, what happened, my dear student? After that, the exchange rate on the balance sheet date. So balance sheet date, what happened? On 31/3/2024. What happened 31/3/2024, my dear student? That is, again we have to subsequently measure, because what happens, this creditor is what? Is the monetary or non-monetary? Monetary, because we know how much we need to pay to our creditor. But if it is a non-monetary, then we will not remeasure it. in the balance sheet date, right? Okay, so now what happened? Now previously we have to pay how much, sir? 75. On the balance sheet date we have to pay 74. That means what happens, sir? Our creditor reduce. We don't have to pay now 75, we have to pay how much, sir? 74. That means what is this, sir? This is the exchange difference, correct? Exchange difference. So any exchange difference, right, it has to be transferred as a profit and loss account. So now creditors has increased or decreased, sir? Or creditors has decreased. So creditor decrease, now that is our profit. So what we write here then? We write here, so creditors, it will reduce. So creditors account debit to what, my dear student? To exchange difference account, which will go to where, my dear? Profit and loss account. How much it is? Which is $15,000 into rupees 1. $15,000 into rupees 1. Are you getting my point, right? This is what we need to do on the date of balance sheet. Next, on the date of settlement, actual payment. How much actually you are making the payment, sir? Only 73. But in my balance sheet, creditor at a 74. Then what we should do, sir? Again, we have to pass one entry on 7/7/2024. What we do? We have to make the payment. We write here creditors account debit. Sir, how much is the creditors in our books of accounts? Creditors in our books of accounts, $15,000 into rupees 74 to what, my dear student? To cash or bank. How much we are going to pay, my dear student? $15,000 into rupees 73 we are going to pay, and balance right here as a exchange difference, which will go to profit and loss account, which is $15,000 into rupees 1. Is that clear? Yes or no? So always remember, whenever there is a foreign currency transaction, three things we have to remember. Number one, initial recognition, subsequent recognition in that balance sheet date, and settlement date. Is that clear? And when you subsequently recognize, you may get some exchange difference. That exchange difference has to be transferred to profit and loss account, right? But there is one exception. So what is that exception, sir? The exception is given in para 46 and 46A. What is that exception, sir? What is the general rule? That any exchange difference arising from foreign currency transaction, that exchange difference has to be transferred to profit and loss. This is the general rule. What is the exception? Exception means you should not transfer to P&L account. Instead of P&L account, what will you do, right? That is called exception. Okay, what is the exception, sir? Listen. This option is available when company has long-term foreign currency monetary item. Always remember, if it is a non-monetary item, this exception is not available. That means you might have taken the loan. If you take the foreign currency loan, so loan become your monetary item, and that is what's a long term. So this option is available when the company has long-term foreign currency monetary item. That means foreign currency loan. Now, when you take a loan, like if you have taken the foreign currency loan, and that foreign currency loan you utilize for purchase of depreciable asset, right? You have taken the loan for what? You have not taken the loan to to do the party and all, right? To celebration and all. No, you have taken the foreign currency loan for what purpose? To purchase the asset. That asset can be depreciable or non-depreciable, right? If the asset is a depreciable asset, then what they said, if you have taken the foreign currency loan, right, this foreign currency loan is what? It is a monetary item, right? It is what, sir? Monetary item. So in this monetary item, you have to measure at the balance sheet date. So definitely there will be some exchange difference. That exchange difference will go to where, sir? In the P&L account, general rule. But instead of transferring that exchange difference to profit and loss account, what you can do? So first thing, if you have taken the loan and utilized for the purpose of depreciable asset, then the exchange difference should be adjusted to the cost of the asset. That means what? If there is a exchange loss, you add the loss to the cost of the asset and charge the depreciation. Or if there is a exchange gain, right? When you measure at a balance sheet date and that loan is there, that loan you are going to measure at the balance sheet date, and there is a exchange loss. So add that loss, instead of transferring the loss to profit and loss account, add the loss to the cost of the asset, and then you charge the depreciation. Or if there is a gain, exchange gain, then subtract the exchange gain from the cost of the asset, right? Okay, if you have taken the foreign currency loan and that foreign currency loan you have not utilized for the purpose of depreciable, you purchase some other asset, right? So that time the exchange difference should be transferred to separate account called foreign currency monetary item translation difference. Are you getting my point? So in the reserves and surplus it will appear, and it has, this reserve has to be written off over the loan tenure, right? If the loan tenure is a 10 years, so 10 years you have to amortize this reserve through profit and loss account, right, my dear students? I hope it is clear to everyone. Again I repeat, this is an exception. If you want to follow, you can follow this exception, which is a para 46a. If you don't want to follow, don't follow it. Directly transfer the exchange difference to statement of profit and loss. Okay, right, come to the next one. Yes, okay. After that, my dear student, come to the next thing, that is called classification of foreign operation. So we have completed now what? Foreign currency transaction, right? Next we are going to discuss foreign operation. Now there are two types of operation. Number one, integral operation and non-integral operation. So what is integral operation? Integral operation means when the branch, that means when the foreign branch carry same or substantially same business as carried by the head office, because whenever we say the foreign operation is nothing but the foreign branch, right? So when you study the branch accounting, there you might have come across these foreign branches, right? But I'm revising here your foreign branches, so no need to worry. So there are two types of branches. One is called integral or non-integral. So integral foreign branch means those foreign branch which carry same or substantially same business as carried by the HO. What HO is doing, same business the branch is doing, we call it the integral foreign branch. Non-integral means which is not a integral, right, which is carries other activity than a HO, right? Okay, so my dear student, whenever there is a foreign branch, see, we are a head office, correct? We are in India. Now branch is in the US, so that branch TB we need to bring in a HO books, right? But branch TB in the dollar, right? HOTB is in the rupees. So can we add rupees and dollar? Not possible. What we should do? Then first thing what we need to do, we need to convert the foreign branch TB into a reporting currency by using the exchange rate. Yes, okay sir. But any exchange difference arising, that exchange difference has to be transferred to profit and loss account, right? Okay, same thing, non-integral foreign operation which does not carry the same or similar business as carried by the HO, right? Now if there is any exchange difference, when you translate the foreign currency item TB into a Indian currency, into a reporting currency, right, that time there will be some exchange difference. That exchange difference will be transferred to foreign currency translation reserve account. Is that clear? Repeat, my dear student, if it is an integral foreign operation, we have to transfer the exchange difference to profit and loss account. If it is a non-integral operation, we need to transfer the exchange difference to foreign currency translation reserve account. Okay, next, my dear student, what is next one? Now you may ask me, sir, now how to convert the foreign currency foreign branch trial balance into a reporting currency, right? So I have given you this chart, right? Please focus here. So first one, item of income or expense. If the item of income or expense now like TB, we have the item of income, expense, asset, liability, right? So if the item of income or expense, you can use the transaction date. Generally transaction date will not be given in the question, so always use the average rate. So what is the average rate, sir? Your opening plus closing rate divided by 2. When you take the opening rate plus closing rate divide by 2, we get a average rate. Same thing for a non-integral also, that is transaction date or average. Okay, transaction date rate or average rate. Is that clear? But generally in exam, I have seen that they will not give you the transaction date rate. They will always give you what's our average rate. And average rate, if it is not given, you can calculate that opening plus close divided by 2. Balance sheet item. If it is a balance sheet, now there are two types of item in the balance sheet, monetary or non-monetary. If it is a non-integral operation, now listen carefully. If it is a non-integral operation, whether it is a monetary or non-monetary, both the item we need to convert by using closing rate. If it is a integral operation and in that if it is a monetary item, you should always apply the closing rate, and if it is a non-monetary item, then rate of a date of purchase. For example, building is a non-monetary item. When you purchase the building, that date, what was the rate? That rate you should apply here. Is that clear? But if it is a, let's say, debtors, debtor is a monetary item, you should apply the closing rate. Is it clear? Okay, so by using this exchange rate, you can convert the foreign currency or foreign branch trial balance into a reporting currency. Okay, so right, my dear students, up to these two things we have completed. Number one, foreign currency transaction. Number two, foreign operation. Okay, come to the next one. There is a last part. Okay, before that, now if you want to reclassify, first it was a integral, now you want to convert to non-integral. So whenever you can change integral to non-integral foreign operation, that time any exchange difference arising, you should transfer to FCTR, foreign currency translation reserve account. Is that clear? Because first thing, when you try to understand, whenever it was an integral operation, that time you transfer the exchange difference to where? Profit and loss account. When it was a non-integral operation, you transfer the difference where, sir? In foreign currency translation reserve. Now, integral, from integral operation to non-integral operation. So non-integral, where it will go? So foreign currency difference, it will go to foreign currency translation reserve. That is what we are doing here. Now, vice versa, from non-integral foreign operation to integral, then what we should do, sir? Very simple, transfer the exchange difference to profit and loss. So then when it was a non-integral, that time we created FCTR. What we should do with this FCTR? Don't do anything, leave it as it is in the balance sheet under the heading of reserves and surplus. Right, my dear student? Okay, last segment, that is forward contract. So what is forward contract, sir? Forward contract means the contract which entered today to protect tomorrow. Right? The forward contract are entered for two purposes. Number one, for hedging purpose or for speculation purpose. Right? So hedging na sir, what do you mean by hedging? So my dear student, please try to understand. So whenever you enter into a forward contract for hedging, to manage the risk, right, you feel that in future rate may increase. For example, you purchase the asset in foreign currency, like where a settlement required in foreign currency. Now you need to make the payment in foreign currency, and you have the risk that dollar may appreciate and rupees may depreciate, because our rupees is always depreciating only. Our rupees is crying. Try to understand, my dear. Try to feel that. Right? So now what happened, my dear? So we need to pay in rupees. Correct? But what is the payment? We have rupees, but we have rupees. Can we pay in the rupees? No, we have to make the payment settlement in the dollar. Right? So that time we need to protect our risk. Correct? So what we do that time? Please try to understand. What is the accounting treatment, sir? So I told you forward contract is for two purposes. Number one, for hedging purpose and speculation purpose. For hedging purpose, what is the accounting treatment? The premium or discount arising at the inception of such contract should be amortized over the life of the contract. Please try to understand, my dear student. Now, we know that how much we need to pay in future or how much we are going to receive in the future. and today's rate also we know. So suppose my dear, today $1 is equal to, please listen, $1 is equal to rupees 85, and in future this is a spot rate, and suppose I am entering the forward contract, so forward rate is $1 is equal to 87. So we know what is our risk now, that is 2 rupees, that's it. So our risk is defined now, so that is called hedging purpose, right? So let's take one example. First of all, let's see. Rao Limited purchase a plant 1 lakh US dollar on 1st February 2024, payable after 3 months. Very good. So when we purchase 1st Feb, we purchase, payable after 3 months. Company enter into forward contract for 3 months for 49.15 per dollar. Very good. So we know very well. What we know, sir? We know our risk. How much is our risk? Correct? Okay. Then exchange rate per dollar on 1st Feb is 48.85. How will you recognize the profit or loss in the forward contract in the books of Rao Limited? First one, what's the forward rate? 49.15. What's the spot rate, my dear student? 48 point this one. So this is what, sir, we have to pay more money now. Correct? How much more you are paying? 30 paisa more. How much is the contract? The total amounts payable $1 lakh. So $1 lakh into what, sir? $1 lakh into 30 paisa. Total we need to pay 30,000. But it's 30,000 we have to amortize over the life of the contract. So what is the life of the contract, sir? The period is 3 months. So we should amortize over the period of 3 months. Now in this 3 months till 31st March, because we enter into contract 1st Feb, our accounting year is getting close. When, sir? 31/3/2024. So how many months are there, sir? Feb and March. That's in total 2 months. So 2 months expense to be recognized this year, and 1 month expense to be recognized in the next year. X means loss. Correct? So my dear student, the contract period is 3 months. So what we should do? That is, loss to be recognized in the current year, how much, sir? 20,000, and next year loss, how much, sir? 10,000. Is that clear? This is called hedging purpose, right? So whenever there is a hedging, always remember profit or loss we recognize over the contract period. Okay, how to find the forward rate minus spot rate? Okay, come to the next one. If it is a speculation, that means for trading purpose, you enter the forward contract. So profit or loss on such contract should be calculated by comparing the forward rate and sale rate. But in this case, this is a trading. So trading, you should not amortize your profit or loss. The day when you sell the contract, that day you should recognize entire profit or loss in your books of accounts. Okay, so what happened, my dear student? Let's try to understand through example. Mr. A brought a forward contract for 3 months, $1 lakh. 1st December 2000, right? $1 is equal that time 47.10. When the exchange rate $1 is equal 47.02 on 31st December. Okay, when he closed his books of accounts, that time $1 is equal to 47.15. On 31st Jan, he decided to sell the contract. We need a selling price and forward contract price, right, per dollar. Show how the contract will be recognized. So this is not what, sir? This is not for the purpose of hedging, because they have not said that purchase machinery or purchase go anything. How they said? No, that means nothing is mentioned now. Here they just say we have entered into forward contract, means it is a speculation. It is what, sir? It is speculation. It's for trading purpose. So what is the forward rate here? They have given, my dear student. So forward rate how much? Where is the forward rate here? See, forward contract is 47. What is the sale rate? 47.18. Let's see here. So sale rate 47.18. Contract rate 47. So we have what, sir? We have sold what? At a premium. Profit for us 1 lakh. So total profit is 1 lakh rupees will be recognized at the time of sale. Is that clear, my dear student? Right? So this AS is very important. When you do the foreign branch, please see this video. It will be very, very useful for you, my dear student. Right? So okay, my dear students, I request you, if you have not subscribed our YouTube channel, please subscribe our YouTube channel for more updated video, right? So it's time to say tata bye bye to everyone with a beautiful smile on your beautiful face. Thank you, my dear student. Take care, study well. Bye bye.